Hey guys, welcome to another episode with me, Shashank Udupa, and in today's episode, we are going to look at why is this the best time to invest in equity with statistics and log-based analysis. So we're going to look at all of that in today's episode, so stay tuned. Now, a viewer asked me recently, right? He said, "Sir, I've started my first job a couple of months ago. I want to start investing in the equity market via mutual funds, but I'm worried about the market. Is the bull run ready right now? Is it going to become a bull run? Am I too early? Am I too late? What should I do? Should I start now? Should I wait? Should I wait for the momentum to die down?" Now, these are all very simple questions that all of you guys have as well, right? So today what we'll do is we'll analyze all of this. Now, if we buy into the incorrect belief that over the long term, the stock market will always move upwards. Okay, great, awesome, right? Equity investing is like climbing basically an unknown hill or maybe even a staircase, but we do not know how wide or how far each step is. Now, it can be extremely educative when the Sensex chart is basically plotted such that the past bear and bull runs can be compared to each other with recent movements. Now, this can also be accomplished by plotting the Sensex closing value as an logarithm. Okay, we're going to look at all of this. So a log chart is also known as an equal interval chart, which will basically give me a beautiful representation of both the rise and fall as well. Now, the most striking feature of this chart is 2008 and 2020, where we saw the bull run and the bear run at the same time, and we saw a crash as well. Now, before we go into the log chart, let's thank our investing partners for this video, which is Smallcase. Now, they analyze the current bull run, and as we try to figure out the next bull run, you can also invest in some of their free and paid small cases. The best free ones are Equity and Gold and Horizon 2030, the really good ones, and some of the good paid ones are Brand Value and Value and Momentum from Windmill Capital. Now, if you want to subscribe to their paid small case and get access to 50 Windmill small cases, then click on the link below. It is an affiliate link and you can get a 15% discount on that. Okay, now let's get back to the video. Now, I'm going to show you the Sensex log chart, which is a plain log chart. Okay, now notice how the past features have now not only become very prominent, but are also on the same scale as the newer features. Number one. Now, if you see the lines, okay, the green lines, let us look at the green line at the bottom left of the picture. It represents the bubble before the Harshad Mehta scam. The increase in Sensex value over the course of this green took only 1 year, a leap from 3 to 3.6, right? Now look at the second green line between the two dotted horizontal lines. Now this is the great bull run in the 2000s. This increase is identical in magnitude to the Harshad Mehta bubble, except that it occurred over 3 years, right? Now this is a simple illustration of the power of log chart. Next, let's look at the red lines. Now the red lines, as you may have guessed, represent the crashes. Now the Harshad Mehta scandal, the dot-com bust and the 2008 crash are very similar with respect to its magnitude. A fact that the plain chart cannot actually reveal, right? And finally, we look at the violet lines. Now they represent sideways market or consolidating market. The first one lasted more than a decade. The second one is a projection in time as well. So we will look at how this works. Now the staircase pattern that you can see should be obvious now. Every big upward movement so far has resulted in a prolonged sideways market that would last for years. A fact that new equity investors like you guys should be aware of. Okay, so the stock market is like a mercurial batsman, like Sehwag, right? It can explode and provide a magical life-changing returns and hit six everywhere. That is what we saw in 2003 to 2008, and we also saw that from 2020 to 2022. Or we can go through a really bad form or slump years, as you call it, where the Sensex was flat for 10 years after the Harshad Mehta scam. Why? Because people were scared to invest in the stock market, right? Many people believe such a thing will never happen again in India, and now it is economically stronger, but every time the same thing happens. Now, a majority government is also a key driver in the stock market gains. So if there is a hung assembly, the return over the next few years we have seen is quite poor. In other words, there is no guarantee and the future is completely unknown. So we cannot guarantee what is going to happen. So the simple secret behind a successful stock market investing journey is to basically start early and keep investing for a long period of time. When the bumper returns arrive, your life could change. So in the stagnation market, you should buy and accumulate. In a sideways market, in an upward market, you start exiting. Now accumulate as much as possible, which is market linked capital, so that you can benefit from that upswing that comes later on. So everyone is waiting for a return in one way or the other, and everyone is trying to time the market in one way or the other. So timing the market is not different at all. It is not very easy. Timing the market refers to some form of tactical asset allocation. Okay, the use of some method to exit when the market is overheated or has lost momentum, and to re-enter when the market has cooled down or gained momentum, right? So basically, if it goes up too much, that is when you start exiting, and when it comes back down, which is current point, which is the consolidation zone, is when you start investing as well. A lot of AMCs and sales guys will tell you that time in the market, invest in SIP over a long period of time. Now, obviously, they're saying temporary, all this volatility is temporary, and you should look at the eighth wonder of the world, which is compounding, and that is permanent. But they do not say so in so many words. Why? Because the impression is made out clear. If you stay invested, better returns are guaranteed, obviously, for a long period of time. But if there is one thing that is constant about the stock market, that is volatility. Volatility means up, down, left, right, sideways. Okay. So the market can only move in three directions: up, down, and sideways. Okay, so when it goes down and it's sideways is when we buy, and when it goes up we start selling slowly and re-enter in those two phases. Okay, now at the onset of the pandemic, markets initially crashed but recovered in the hope of a great future economic recovery. Then the implications of lockdown, government bailouts and all have started coming up in the last few years, and we also saw what the implications they have, which is your obviously higher inflation. So currently there is no news to drive the market up, and there is no serious bad news to drive it down. That means what market we are in? Right, we are in a sideways market. Several backtests show to compare the time in market versus timing the market and different timing strategies. Now, timing the market to reduce your portfolio risk is quite easy, but with most strategies, timing the market for better return is also sometimes down to luck, because you cannot predict when it's going to go up and when it's going to go down. Right? Even if I come across a timing strategy that actually works, more often than staying invested, it will not guarantee a very good future. And obviously I'm not going to be patient also, because my emotions will run up and down. So timing and buy and hold backtest do not include something called as human emotions, and there is no way to test human emotion backtesting, because if the market goes down by 30%, boss, even I'll get scared, right? And I'll not invest, and I cannot do that. So now what is the answer, right? Do we invest right now? Do we not invest right now? Do we time the market? Thankfully, we need not know this, right? Now, we do not need to time the market, first of all. All of this was just to require and understand how the market is working and how a systematic goal-based portfolio management should be done. Now, since there is no guarantees, and the next best thing to do is to be aware of what is happening with our future needs, how much we need to take. So basically, you just protect and prevent anything that is happening. Now, if we call this current market a sideways market, then according to the logarithmic scale that we saw, this is the best time to invest in the equity market. Now, if you guys are actually looking at how to invest for a very long period of time with your goals in mind, then you can definitely look at Horizon 2025, which is Windmill Capital by Small Case. You can look at their portfolio. Basically what it does is it basically optimizes your investment value for the goals for 2035. Now there's a way they do this, right? If you look at the actual ETFs and weights that are there in this particular small case, you will see that they have something called as a Bharat bond, which is debt, and they have something which is Nifty 50, which is the index fund, and they also have gold, right? Which is gold is basically 13% allocation. So 54% is a debt instrument, which is fixed income. Out of that, 32% is Nifty 50 and 13% is SBI Gold ETF. Now, if you're planning to do a goal-based investing and you say my goal is going to be for 2035, then you can start investing in something like a Horizon 2035 small case. But if you feel like, no, Shashank, I want something even further, then you can go for something like a Horizon 2050 small case, right? Now, what happens? I'll show you the difference between 35 and 50. You see, in 50, they've given more allocation to the equity element and less allocation to the Bharat bond and the gold element, right? So mainly what Horizon portfolio does, as in when it's coming close to your horizon, which is your main 2050, they start reducing the allocation of equity and increasing the allocation of corporate debt, which is fixed income. So that way you get the best investment for equity because you're there for a long period of time, but eventually it also reduces your thing according to your goal and gets your fixed income fixed, right? Because in the later half of your life, you don't want a very volatile asset. So you should definitely check this out. You can just quickly invest in this and figure out how this works out as well, and you can do a one time or you can even do a lump sum. I would prefer, if you're doing a goal based investing in this, the minimum amount is only 500, so you can easily do it. It's free of cost as well, and you can start investing in this also. Okay, so coming back to the video now, to accumulate stock, or you can accumulate mutual fund unit as much as possible within a planned asset allocation. Obviously don't go invest a lot of money in penny stocks, then you lose a lot of money. Now sooner or later the market will start moving up, and when the stock market starts moving up in a beautiful journey, that is when your life changes, and that is when you become rich. Now, hope you understood what I was trying to lay down here, right? So please do not get worried about missed opportunities, because the equity market will offer you hundreds and hundreds and hundreds of opportunity, because sometimes it goes up, sometimes it goes down, sometimes it's sideways, but ye hota rahega, right? So basically you just need to be clear about your goal, find a good asset allocation, invest as per that asset allocation, don't over invest, don't under invest, increase your investments in a bear market or a sideways market, learn how to manage risk in your portfolio in a goal based manner, number one. After that, rebalance your portfolio when we see that the asset allocation has gone more than 5% and it's become too much, reallocate it, right? And systematically reduce your equity investing allocation when you think the market is overweighted, right? When the market is overheated, this is the time when you slowly start pulling out. Now it's very difficult to time the market. I'm not telling you to time the market, but looking at the past history of Sensex, how it has gone up, massive bull run, how it's gone down, a massive crash, and how it's remained sideways for a long period of time. If you look at all of this, currently right now would be a very good time to start accumulating a lot of instruments linked to the market, and then eventually scaling it down when the market starts overheating and going up. And you'll know very well when the market starts overheating. So I hope you guys understood this basic idea of how the Sensex has been looking from the last few years, and how you can basically use it for your advantage. This is me, Shashank Udupa, trying to get you some interesting information apart from just simple stock news. Okay, so this is me, Shashank Udupa, signing off. I hope you guys like this episode. Stay tuned and I will get more content for you. Bye, take care, see you.